Even though full-time doctors in the US earn on average $208,000 a year, this alone may not be enough to achieve financial freedom. If you're a doctor or another high-income earner, it's important to understand how and where to invest your income. Well, that's exactly what we're going to be discussing in this video. If you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to get you out of the rat race with passive income. Do me a favor, download the free passive income below this video. Let me ask you a question. Are you currently trading time for money? If you work at a hospital or clinic, you're used to receiving a regular paycheck, okay? Regular times probably every other week, something like that. This is the standard trade time for money strategy. There's a clear relationship between work and compensation while working like this. In other words, no work equals no what? No money, right? So most of us are aware of how the stock market works. Before becoming a real estate investor, I was 99% invested in mutual funds. The majority of money made in the market comes from stock appreciation. However, unless you sell them, the earnings that remain in your account, they're just merely speculative. This is not the situation when it comes to whenever you're investing in real cash flowing assets. If you own an investment property, the tenants pay you rent each month and you benefit from the property's appreciation. By developing multiple streams of income from real estate, you're actually able to pay for your personal expenses every single month and end the dreaded time for money problem. So now I want to get into how you can start investing in real estate, okay? And we're going to talk about some active ways and passive ways. So before you get into investing in real estate, you should first answer the following question. And you need to think about your situation. Should I invest actively or passively? In other words, do you want to be hands-on, dealing with tenants, dealing with maintenance, that sort of thing, or not, or hands off, okay? For most professionals, the answer is passive investing because our biggest wealth generator is what you know, is what you've gone to school for, is what you've time, energy, money, debt, effort. It's your income. It's your active income, okay? That is your biggest wealth building tool. So think about, think about how much time, money, and energy that you put in to get to where you are today. Doctors, dentists, attorneys, they spend a lot of time and money and effort to attain their degree. And their time is better focused on, for doctors treating patients, for attorneys treating clients, whatever. So when you start dealing with tenants and all the maintenance problems that come with being an active investor, you have to cut time out of your family, going to ball games, travel, whatever. You're like you're always on call. So again, it's up to you whether to invest actively or passively. My goal for you is financial independence. And I want you to get to the point where your passive income replaces that W-2 or active income. And real estate is a great way to build financial security because there's all kinds of different ways to get started. And it's your job to find out which part of it is going to help you accomplish your goals. So first thing I want to do is start with the different strategies when it comes to active real estate investing. Okay. This again is also known as being hands-on. This is somebody that's involved with the acquisition process, including you're going out, you're finding the deal, you're performing the due diligence, you're going to have to secure financing, you're maintaining the property, you're managing the property. And at the end, maybe you'll sell the property. Once your rental property closes, you're also involved in property management. You have to advertise to get tenants in, right? When the tenants come in, you have to do what? You have to screen them, make sure you don't have any mass murderers, just like we had one in our mobile home park when we bought that we didn't know about. So you have to screen them, okay? Background checks. You have to write and sign lease agreements. You have to collect rent. And a lot of times you have to be available 24/7 for solving repairs or problems, okay? So the first thing I want to do is talk about what are the benefits, what are the pros of active investing. The first thing is you have complete control over the investment. It's yours. You don't have to take advice or you don't have to take anything from anybody else. You own the property. The second has to do with tax advantages. They go straight to you, straight to the real estate investor, not like some of the other things that we're going to talk to in a little bit. And the third is minimal cost as a leasing agent or property manager isn't employed because you're the one that's doing it, unless you choose to not do it and then your costs will go up. Now the cons are you as an active investor, you must fully understand what's involved with property management, okay? And you also have to have detailed knowledge of all the different growth trends and make sure you know about the landlord tenant laws of your area, of the market that your property's in. And it's also, a lot of times it's hard to scale when all all the rental properties are actively managed. Now, some of the different types are fix and flip, short-term rentals. That's like Airbnbs, VRBOs, stuff like that. So a short-term rental is a property that's usually rented out for less than 7 days at a time for vacations or business trips. And with the rise of online platforms like I said, Airbnb, VRBO, it's never been easier for almost anybody with a vacation or second home or rental property to use it as a short-term rental. And many times the short-term rental investor, they can make more money than a long-term rental investor because they can charge more and then they can turn over the residential properties quicker. But investing in STRs, it also takes more work, as it's very similar to being in the hospitality business, like running a hotel. And investors are constantly, they're having to market for guests. You're having to make sure everything is turned over, it's clean, it's furnished, and you're doing everything that you can to make sure you get a good review. You want your tenants to leave you a good review, because a lot of times that's how, when you're searching for a short-term rental, that's how you're going through. Well, what kind of reviews do they get? Okay, so now let's shift gears to passive investing. Years ago, after I hurt my wrist snow skiing, I realized that I needed to find other ways to make money besides using my hands and practicing dentistry. And that was the wake-up call for me. And this accident, this incident, it eventually led me to start investing in real estate, but I started off investing passively. Unlike active investing, passive real estate investing is completely hands-off. This means that you're putting money into real assets without having to take care of the day-to-day running of them, which is really good news, right? So the risk is much lower than with an active investment. Somebody else is doing it for you. And again, this type of investing is great for busy, high-income professionals with limited time, yet wanting passive income streams. So again, let's talk about the pros and cons of passive investing. First, you don't have to have that much knowledge when it comes to property management. Actually, you don't have to have really anything, because you're not the one that's doing it. Less time consuming versus active investing. Again, somebody else is doing it for you. It's the syndicator that has the real estate syndication we're going to talk about it in just a few minutes. And then also the diversification is easier, as you can invest in smaller amounts of money. So you don't need as much capital to get started versus having to put maybe a larger down payment when you're buying a property actively. So now let's talk about the cons. You have significantly less control over the real estate investment if you're passively investing. You're passing that control over to somebody else. And then you don't have as much, and you have less tax advantages. Okay, so not all tax advantages are available to you as the investor. And then you're going to have more overhead, you're going to have more fees that could be paid to third parties who supervise the investment, and then they're going to profit from it. Okay, so now let's shift gears, and I want to talk about two of the more popular passive investments, yet many times people think they're the same thing. Okay, let me make a little bit of room here. All right, so here's your two main ones. The first is a REIT, okay, and the next is a syndication, which is my current favorite investment. So you have a REIT and you have a syndication. So when you invest in a REIT, which is a real estate investment trust, you're buying stock, okay? So you're buying actually stock in a company that buys and sells real estate. That's the key word there, stock. Now these REITs, they can either be public or they can be private. Hotels, apartment buildings, self-storage, things like that. Those are a few examples. Investors can purchase these shares simply on the stock market by buying a stock in a single company, mutual fund, or an ETF, or an exchange traded fund. That is what a REIT is. The REIT is nothing more than like investing in a stock in the stock market. Syndication, on the other hand, this is when a group of passive investors pool their money to buy real estate properties that are too expensive for any one person to buy on their own. Now, the SEC, the Security and Exchange Commission, is actually in charge of these investment opportunities, and you have to file paperwork like a PPM, like a private placement memorandum. And if you're limited partner, which we're going to get to in a second, you have to worry about that. But if you're a general partner, they're the ones that take care of everything. So the two main groups are the general partner, which are the syndicators, and the limited partners are the passive investors. Okay, their roles are to do everything. They find the deals, they underwrite the deals, they do the due diligence, they put it under contract, they obtain financing. They're the ones that are responsible for managing, and then they provide the individual investors, the passive investors, financial information. Think of them as pilots on the plane. Think of them as the passengers on the plane. They both have the same destination. Same destination is making money, right? yet they're in charge and they're not. So this group is made up of people who choose to invest without, they don't want to take a lot of risk. They have no active responsibilities in managing the asset. Okay. So let's talk a little bit about what are some of the benefits of real estate investing. Okay. Well, probably the number one reason people want to get into it is for passive income, right? Cash flow. More than likely you're working hard for your money, yet you may only have a W-2 income to show for it, which is what? It's taxed at the highest marginal tax income rate. And if you fall in this category, the harder you work, the more taxes you're going to get paid. Real estate investing can generate passive income with little to no effort, which guess what? This money is taxed at some of the lowest rates out there. And the IRS differentiates between passive real estate income and earned W-2 income. Now, withholdings for federal and state taxes, you got FICA and FUTA and SUTA and all that, they're required on your earned income. Okay, you probably see it deducted from your check every time you get during the pay period. However, passive income from real estate is often not subject to withholdings and is taxed according to a taxpayer's tax bracket. And collecting rental income is a great way to boost your personal finances. And what I like about it is you increase your cash flow, because that's the main reason I invest. And we're using all this extra income to replace our annual expenses. This helps out in, again, breaking that trading time for money rat race that we're all on. And we've another benefit, and we've touched on this quite a bit, are the tax benefits that real estate gives you. Okay, depreciation is the main one. This is a tax deduction that allows rental property owners to actually deduct the cost of their property, the wear and tear of their property over time. Now, the Tax Cut and Jobs Act actually reintroduced bonus depreciation, which actually allows you to deduct a percentage of the cost of your property in actually year one, in the year that it was purchased. So from 2023 to 2026, this benefit is starting to phase out, after which investors would still going to be able to depreciate their property, just at a little bit slower rate. And then you could also benefit from using bonus depreciation by conducting what's called a cost segregation analysis, cost seg for short. So you can get this on your property to establish out which of the components of the building are dedicated, decorative, or removable. Okay, it segregates out the property, because different parts of your property are going to wear down quicker, like the roof, the flooring, the painting. They have wear and tear schedules. And again, these items may qualify for a lot of the bonus depreciation in the year that they're purchased. Okay, this benefit is estimated to be anywhere from 20 to 25% or even higher with RV parks and mobile home parks of the purchase price of the building. Another benefit of real estate, unlike the stock market, it's less volatile. Okay, it's less volatile. It's Real estate is known for being recession resistant, okay? Unlike the stock market, which is a very highly liquid investment, right? Any bad news out there, somebody can tweet something or put something online, it can force a big sell-off, okay? We've seen this happen before. Real estate, on the other hand, doesn't really, anything like this, it doesn't typically affect the value of the property. Speaking of the value of the property, what happens to property over time? If you have a house, you've probably seen this, right? Your house is going to appreciate, it's going to go up in value, okay, over time. So in general, the value of real estate, it tends to go up over time. And several of the properties that I've invested in, there's something called forced appreciation. This is where people buy the property, they update it, they renovate it, which allows the rents to be raised or to force the appreciation quicker than normal. And a buy and hold strategy is a great way for high income earners to build wealth over the long term. We're constantly acquiring properties every single year and we buy them and we hold them to generate this cash flow. Okay. So here's the bottom line. If you want to put your trust in the stock market, always worrying if you're going to have enough money in your 401k, or wondering if the stock market is going to be high enough up in the year that you want to retire, or you're worrying about, am I going to run out of money in retirement? Then I want you to consider the alternative we talked about today. Imagine having checks come in to your bank account every single month and not being so concerned about inflation, because guess what? As inflation goes up, the rent goes up too, right? So I hope this video helped open your eyes to the alternatives out there when it comes to your hard-earned money. See you in the next video.